Welcome to the Wealth Under Pressure podcast. Financial success very often has less to do with owning a financial product, earning a high income, or even being frugal. Instead, the path to success comes from having a comprehensive plan that enables you to optimize decisions and avoid mistakes. Join John Smallwood, a certified financial planner, as he identifies key areas of pressure on people's wealth and strategizes to reduce it. It's time to liberate your wealth.
Hello and welcome to another podcast with John Smallwood. Prepare yourself, listeners, for a mini-series. John is going to start doing a mini-series on protecting your most important asset, which is you. It's hopefully going to be a 5-part mini-series. It might end up being 6, but we're going to shoot for 5 right now. And so you're going to want to stay tuned to all of these podcasts because this is where we're going to break down exactly what protecting your most important asset you really means. So John, welcome to the show.
Thank you, Matt.
Yeah.
Good morning.
Hey, good morning. So high-level stuff here. Let's talk about what do you mean by protecting your most important asset?
So the question that I ask a lot of people when we first meet them or, just cocktail talk is I ask the question, what is your most important asset? And I get a variety of answers. My real estate, my business, my stock portfolio, my relationship with my wife, you get all these interesting answers. I almost never actually get the answer of me, the individual that we're talking to. It's always something that is outside of what we're talking about. And the reality is when I start having the conversation with these people, it's your ability to get up and work every day, your ability to take risks, you turned your company into what it is today because of your due diligence and your hard work. You're the person that's responsible for that. You paid for your kids' colleges. You put money aside. You help your parents out. All these things that you've done in your life, and they forget that this is the most important asset, and it's the most underprotected asset in the majority of financial strategies that I encounter. And we don't tend to think of ourselves as the asset, but without the person, nothing in the financial plan would have ever happened. We have so many clients that come in today, they're making $100,000 a year. They're in a business or they're starting a business or they're in a business that they don't like being in. They're going to leave. 10 years later, they could be making 10 times as much money. They never dreamed of it. They never fathomed of it. And the present is not necessarily going to repeat itself into the future as well. So the most important asset in the financial plan are the spouses. It's the individual. It's the husband and wife. Those two people and their contribution to the household are the most important.
So let's break it down. What are the major categories of protection that we're going to talk about in this series?
So as we go through this, we're going to be talking about ways to protect the asset. Life insurance protects the asset, which is you. Disability insurance also protects the asset, which is replacing the income if you, the individual, can't get up and go to work, okay? And you're here. So that's what we're going to be talking about. And what the goal of any financial strategy should be when it comes to protecting the assets is to have the maximum amount of coverage for your entire life owned in the most efficient manner so that your wealth and its potential is achieved, enjoyed, and passed on to the places that you want it to go to. And what we talk about always in these podcasts, Matt, is a good financial strategy is going to reduce taxes, reduce risk, reduce fees and costs, increase the savings rate, increase retirement income, put more benefits and more protection around the client's wealth, and pass more to the family. Life insurance plays an extremely important role in this conversation, as well as disability insurance. Okay. And I kind of want to put this, everybody owns car insurance because you're regulated and you have to own it, right?
Yep.
And everybody, not everybody, but most people have homeowners insurance because most people have a mortgage and you're required to have homeowners insurance. And we saw in the last, some of these hurricanes and these big floods, people that didn't have mortgages didn't have the proper insurance and they kind of lost everything, right?
Yep.
As a result of that. So every asset that you own, your car, your boat, your house, your life, your financial assets, your real estate assets, they have what's called an economic value. And when you insure something, you are insuring it for its economic value or its replacement value. So the economic value is defined as this: the value of an asset deriving from its ability to generate income. Okay? That's really economic value. So you have a job, you have a career, you generate income. That's part of your economic value. So when we insure something, we can't insure it for more than it's actually worth, right? We can only insure it for its economic value. So I can't buy a car for $10,000 and insure it for 40.
True.
The insurance company won't do that.
Right.
I can't buy homeowners insurance for more than the economic value of that because it creates a negative incentive, right? The insurance companies won't do it. I can't buy life insurance for more than my economic value. And those formulas are different based on ages and amount of wealth that's accumulated, okay? But I want to kind of put this, if you think about it from a perspective of I own a house, right? And let's say, for instance, the house is paid for, and meaning there's no mortgage, and I have a fire that destroys the house, but I have an equal amount of cash on the outside, equal to the value of the house. Let's just say $500,000 and $500,000. So my net worth is $1 million. The house burns to the ground, and I now have to rebuild the house, and I have to put all the contents back in that house. Okay. So yesterday I was worth $1 million. Today the house burns down, and I'm going to have to take a lot of that $500,000 to rebuild the house and to put all the contents back into that house. So the very next day, when the house is now completed and built back, my cash is now gone. My net worth is only $500,000 because I had to take the money out of the bank and rebuild the asset. Does that make sense?
Yeah, I'm following you, man. Keep going. Yep, you're. Okay. I'm right here with you. Okay,
so everybody gets the fact that buying a homeowner's insurance with proper replacement value and contents replacement at fair market value, not depreciated, true replacement cost. People understand the value of protecting that. Okay, and the cost, if my homeowner's insurance is $1,500 a year, and the house costs $500,000 to rebuild, obviously I want to write the check for $1,500, not the $500,000. That's efficient. That's an efficient use of capital.
Absolutely.
All right. So if I'm going to own a house, from the time I'm 25 years old to hopefully I live, 60 plus years from that point forward, so I get out to 85, 90, I may never, ever have a loss on my homeowners. The house may never burn down. I may not have a kitchen fire. I may not have water. I may not have wind damage. I may not have hurricane damage. I may not have any of those things during the course of my 60 years of owning that house. Make sense?
Yep.
All right. So, and what we're hoping is that house over time continues to grow in value. But you have to look at this, and this is the thing that we talk about all the time, which is opportunity cost. Okay? Is if I pay $1,500 a year in premium and it never goes up, which we know that's not true, and I do that for 60 years, I've paid $90,000 in premiums to protect $500,000, $600,000 of value, if not more, right?
Mm-hmm.
If you knew you weren't going to have a loss, you could invest the capital in something else, right?
Absolutely. The $90,000 you could put somewhere else.
Right.
That's the unknown, right?
Correct. So the focus here is, and this is what I want people to think, and I want them to think strategically. I want them to think with me through this conversation, is that if I, over the 60 years, if I knew I wasn't going to have a loss, But every time I wrote a check to the insurance company for $1,500, I had a guaranteed loss then, right? Loss, 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 loss. 60 years in a row, I paid a premium and I lost. Thank God, because that's a good thing, right? That's what I want to have happen. I don't want to have a loss. But if I look at the S&P over a 60-year period, and let's say it averaged 9% over that time frame, that money, $1,500 a year, every year for 60 years at 9%, guess how much money that would be?
I don't know. You're better at math than I am. What would it be?
I wrote the math down, but it's $2.9 million.
All right.
Okay, so the $90,000 has an opportunity cost of $2.9 million over my 60 years. I hope my house is worth that much 60 years later, right?
Mm-hmm.
So when we're looking at a financial strategy, you have to look at ways to reduce those costs to protect these things. Okay. And you think about it, if I could reduce the insurance cost by 20%, I'm going to recapture 20%, potentially recapture 20% of that 2.9 million.
Mm-hmm.
And the point that I want to make here is that car insurance, boat insurance, homeowners insurance, disability insurance, long-term care insurance, warranty insurance on things that I'm buying, right? People spend a tremendous amount of money on these things. These are things that may or may not happen. We are hoping that they're never going to happen. And if you add up all the money that you're spending on car, homeowners, boat insurance, long-term care, disability insurance, et cetera, the amount of money that you're transferring from yourself to a financial institution is in the millions of dollars potential of your lifetime. So getting it right and making sure that it's the most efficient, basically our philosophy is this: maximum coverage, least amount of cost.
Sure.
Right? That's it. So if we're looking at that, you really want to take the tide. I'm looking at a tide chart. You want to take the pulse of your financial strategy and understand how much of that money is being transferred away. But I want you to really think about this: is car insurance, hope it doesn't happen. Boat, homeowners, umbrella, I hope I don't get sued. I hope I don't become disabled. I hope I don't go into a long-term care facility, and I may not on any of those. Life insurance, I'm definitely going to die. The only thing that's certain in that insurance is death. The time, date, location, and the economics of the time frame are unknown.
Sure.
Right? So when you look at the amount of money that's being spent on life insurance and you look at the amount of money that's being spent on protecting assets that are not your most important asset, we've kind of got it wrong. Okay? So meaning we're spending more money and spending more time on thing insurance as opposed to person insurance.
Right.
All right. And you can buy maximum insurance, term insurance, very inexpensively, very easily. Okay. And it's what's really interesting is if you visualize your timeline and you say, I'm 50, I'm 30, whatever I am, right? Right here, right now. And I look at what's my income, what's my savings rate, what's my family makeup like? Are my parents here? Are my parents not here? Are my parents' liabilities? From a financial standpoint, are my in-laws' liabilities from a financial standpoint? Are they assets? Am I going to inherit money from them? Going back to the wealth curve pressure identifier, how much money am I saving? What are my debt structures like? What's my lifestyle like? What are my assets like? What are my, I have 4 kids. I have 3 children now out of high school, which I still feel like I'm personally about 20 years old, but it's interesting to have these kids that are now in college. We're hitting those college goals. Then you have weddings and you have all these other things that you're trying to accomplish. And those are the dreams that you have. So you picture your timeline, right? And your timeline is you start off in your 20s, you start a job. It may not be the job of your life. And you're going along what I'm going to call the accumulation phase, which is I'm going to work, I'm going to start a business, I'm going to do things. I'm trying to accumulate as much wealth during that time frame as I possibly can. Then there's going to be a period of time which I'm going to have to live off the income from those assets. And then there's a period of time where I want to transfer those assets. Well, it's a short period of time because I'm no longer here in that moment, right? Where I now want to transfer those assets to my family. And it's all that financial pressure during the timeline that is impacting on your wealth. The role of the life insurance is going to change in each one of those phases of wealth accumulation, wealth distribution, and wealth pass it on. Make it simple, right? And we've had this thing. So if you sit here for a second and you think about the contribution, let's say that you make $500,000 per year. You've got a great job. It's the job that you dreamed of. You're not exactly sure how you got here and you're all excited about it. And it's really wonderful, right? So you sit here and you say, okay, I'm making $500,000 a year. We're paying a certain amount of taxes. We're saving a great amount of money and we're looking at that future and we're going to get to this, future outcome of, enough money in retirement that we can live exactly the way we're living today. We've got mortgages, we've got debts, we've got school costs coming, and you back into this and you figure out here's the family lifestyle, here's what we've accumulated, here's what's coming. And what you're looking at is if something happened to the breadwinner, the major breadwinner or the secondary breadwinner in the household, every one of those things changes. Okay. So protecting the asset from a life insurance perspective is bringing enough money into the household to take care not only of the current income, but taking care of all those future liabilities and goals that you have set for your family, for your kids, for those weddings, and sustainable for the entire lifetime of the participant. When I see a lot of I download things on the internet and I look at things, one of the things that's really interesting is, the life insurance, the need, one of the things that I see is how many years are we going to need to protect the spouse and the kids? Well, the kids hopefully get launched, right?
Yeah.
Hopefully.
Yeah, hopefully.
Right? Hopefully. So, we're sitting here and how much money is it going to take to replace my economic value? There's a finite amount of money. If I make $500,000 a year, how many millions of dollars do I need in the bank to produce $500,000 on a pre-tax basis? And there's a thing that comes in that's talking about need, right? Well, we don't need this, we don't need that, we can go back to work, all these things. And we're justifying having less because the life insurance is a painful thing. It's something that we're not going to be here for. Car insurance is straightforward. I get a premium. I want to make sure that I get my $50,000 or $80,000 or $20,000 when the car is in a wreck, right? It's pretty clear. If I owned a rental property that was producing $500,000 a year in income and it burnt to the ground yesterday, what am I going to do? What would you do, Matt?
Well, I would call my insurance company and go ahead and, exercise all of my stuff and report it and make sure that I was going to get paid out.
Right. And what you don't want is you don't want less than what you currently have. You want to get back to the spot.
Right.
Right?
Yes.
So what you need is a lump sum of capital that's going to allow you to build that building back exactly the way it was prior to it being burnt to the ground.
Yeah.
Right? So there's a value to that. There's a building value to that that's going to take place, meaning, you have to have all the construction, you have to have all of that. But that $500,000 building, if you use a 5% cap rate, is worth about $10 million.
Okay.
Give or take. Now, the land has some value, but the structure is worth, the structure and the land's worth about $10 million. And that building, if it burnt to the ground the next day, let's say the land is worth $2 million. And so you still have value in that building, but you need $8 million to rebuild that building back. If you don't get $8 million, you can't build that building back. Well, you can because you have to take it from someone else. You have to take a loan, and that's now going to be more expense. So what I want you to think about is you are a building because you are producing that income. And what I see is there's this rule of thumb that you need, 5 times, 6 times. You see all these the it minimizes the amount of insurance. So if I got 5 times the 500,000, I got $2.5 million. If I use the same cap rate, I'm now only building a building that's going to produce about 125,000. It doesn't make sense to me.
It doesn't. I have a question for you, though, to kind of wrap up the beginning of our 5-part series here. Why do you believe that people don't think twice about auto, home, umbrella, boat insurance, all of those sorts of things, but they rebel against their most important asset, which is themselves? You've been doing this for a long time, John. Can you help me enlighten the audience on that?
It has to do with a bunch of factors. And the biggest factor that I see is that there's a perception that if I protect myself properly from a life insurance contract, it's going to take away from my future retirement, or it's going to take away, or it's going to make somebody else rich and not myself rich. Okay. And our philosophy is, when you implement life insurance into a financial strategy, it should improve the outcome of your financial plan. Meaning if I'm supposed to get to, a certain spot at retirement, by having the max amount of protection, I should be there, and it shouldn't cost me any money. Matter of fact, it should get me to further along than if I didn't own it. Okay. People don't understand that. What we've been trained is that we don't need life insurance in retirement. Okay. And I think that is probably one of the most, biggest misnomers in the entire financial planning industry is, well, the kids are gone, the mortgage is paid for, I don't need any life insurance in retirement. Okay. Now, what happens in retirement upon the first death? The person loses one of the social securities. They may lose, if there's a pension involved, they may lose half the pension. They may lose or all of that pension. They may lose health insurance that was being paid for by the spouse's employer, right? Lifetime health insurance is gone. They end up in a single taxpayer bracket versus a married household. And the core expenses that it takes to run the house do not change, by the way. Food is the smallest one in there, right? And, the insurance companies have gotten us to a point where, and the investment companies have gotten to a point where the insurance companies, and I love insurance companies, but we have to understand they are companies that are in business to make money, right? Mm-hmm. And this transfer of wealth that we're talking about is, if I own a term policy for 20 years and the premium goes from being this beautiful level term premium, and then it goes up from, $2,000 a year to $25,000, I'm probably going to drop that coverage unless I'm really sick, right? Mm-hmm. And now the insurance company says, they send you a bill for $25,000, Matt, and they say, okay, if you want to ante up, you got to send us a check for $25,000. Now, you might be healthy enough, you can go out into the open market and get a new policy and pay a lot less than that. Or you might just say, forget about it, which I've talked to a few people in the last few weeks that have actually said that, and they're in their accumulation phase, and it doesn't make sense to me, but that's what's happening. And now the insurance company basically gets to the point where they've collected $2,000 a year for you for 20 years. They don't owe you a dime back, and now they're off the hook. Let's say the death benefit was $2 million. They're actually having a party down the hall to say another policy has lapsed. Because when you think about a life insurance company, a mutual insurance company, they make money from basically 3 things, right? One is how well the bond portfolio does, and their investments, which are secure, matching 30-year, 40-year liabilities. So they're very secure, very safe. 2, it's the actuarial science. Everybody pees in a cup and takes blood in order to enter the life insurance spectrum, okay? And so they know, because they've looked at your health, they talked to your doctors, they have a pretty good indication of how long you're going to live, barring bad luck. So they get a chance to select the people that are going to be the healthiest. And if you're not healthy, they're going to charge you more premium. But then the third piece, probably the most important piece, is called lapse ratio. How many people lapse their policies? The more people that lapse their policies, the better off the life insurance company is, because now we don't have to pay out a claim.
Right. So I'm sorry, define lapse for us.
Lapse is I got to the end of the 20 years The premium went from $2,000 to $20,000, and I terminate the policy. So
Gotcha.
The policy terminates in a way that no death benefit is paid.
There you go. Okay.
That is a lapse. We can terminate a policy and a death benefit is paid. So the insurance companies, they don't really want to pay you out in the long run. I'm not saying they don't want to. That's what they're here for. That's what they do. I don't want to create any bad blood here, but it's the way they're set up and the way the products are set up is, if I'm 50 versus 80, there's a higher probability that an 80-year-old will die than a 50-year-old. And if the insurance lapsed at 78, the insurance company is really happy because now they're not paying it. They're less likely to pay out a claim. So I think the training and the focus is wrong because I don't think people really understand that if life insurance is properly put into the plan, it actually can help increase the retirement income. And I don't think people really understand that, okay? And there's basically three core types of life insurance policies. Term insurance is a rental. I'm going to buy a policy that I can continue all the way out to 100, but typically you're going to have a premium that's level for 10 years, 15 years, 20 years, in some cases 30 years. But at the end of those timeframes, the premiums will go up exponentially.
Yep.
Talking about that 20,000. So I like to think of it as it's a rental, and I know I can tell you exactly what my future premiums will be on that based upon the contract. Then on the other side is a whole life structure where there's a guaranteed premium that will be payable for a 10-year period or a 1-year period or all the way out to 120 or some function there. Then there's a guaranteed cash value, which is going to give you a certain amount of your premium back every single year. If you stay long enough, you get all your money back on a guaranteed basis. And there's a death benefit that is guaranteed to happen, okay, and based upon those premiums. So the death benefit can't be changed, the guaranteed cash value can't be changed, and the premium cannot be changed, okay, meaning the insurance company has no right to actually change any of that. You have the right to pay that for as long as you possibly want. Then, based on the earnings of the company, the dividends that are being paid, those whole life contracts will share in the profits of the insurance company. And you could actually have a dividend that makes this policy have a great rate of return. But the mortality costs are guaranteed throughout the entire time frame. The hybrid in between those is a concept called universal life, which kind of marries the longer premium structure, which is kind of lower, with some cash value, but most of the time the cost of insurance looks like a term policy where it's going up every single year. And the idea is that potentially could be cheaper in the long run because it's a blend between the term and the whole life, so it's less money out every year. And it's what they're hoping is that it lasts for longer, but there's not as strong a guarantees. And then there's, basically variations of that where we're talking about variable life insurance, which allows you to invest a portion of your money in the stock market. There's indexed, which allows you to, invest it in indexed options. And then there's a whole different variations of that. But what we're looking at is we're going to explore these as we go forward in this process to really talk about the uses of term insurance, to talk about the uses of whole life insurance, to talk about the uses of universal life, how these things work. And so you really understand them. But what you want to look at is from a life insurance perspective, the life insurance is going to protect your economic value in your household. And we're talking about this from a family position. The life insurance is also going to be used in buy-sell agreements, key man coverages for businesses. Corporations own life insurance on their employees often. A lot of big banks own what's called corporate-owned life insurance. There's a lot of different variations of life insurance and many different uses. And what you want to understand is the structure of how those policies work, how they would work in your plan, and what are the pros and cons of implementing those into your plan.
And that's what we're going to be diving into over the next 5 podcasts.
Correct.
Fantastic.
100%.
Awesome. Okay, well, everybody, so John just gave a great foreshadowing of what we're going to be talking about on our next podcast, breaking down each of those major insurance components and making sure that you're going to have a much better understanding of what they are, how they work, and the most appropriate scenario for each. So, John, thank you very much for your thought leadership today.
Thank you.
And if you have not subscribed to the podcast, make sure you do that now because you're going to want to tune into these next 5 podcasts. It also makes it easier for you to share these podcasts with other people. So if you're sitting around the dinner table with friends and family and they're having a conversation about life insurance, this is a perfect mini-series for you to send to them so that they can get the facts from somebody who's been doing this for longer than a lot of you have been alive, and also an enormous amount of experience from an education standpoint, which is John Smallwood. So for everybody at Smallwood Wealth Management, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
Smallwood Wealth Management is a registered investment advisor. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as the receipt of or a substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation.